Hello and welcome into the KE Report. Shad and Corey here as your host, and today we're talking with Sean Brodrick, editor of Wealth Megatrends and contributing analyst to Weiss Ratings Daily. And Sean, always great to have you on the show. Last time we talked, it was actually on tax day back on April 15th. So not a lot has changed in the world, although we've had a wild roller coaster ride in the general U.S. equity markets. They've mostly done a V bottom and bounced back, but we've seen some conflicting economic data, and I want to get you to weigh in on what you're seeing out in the marketplace, because while it seems like there's a sigh of relief that we've had a pause for 90 days in the tariffs, I think some people forget that's just a pause. We still have to negotiate. We have worked out some things with China to some degree, which takes a little bit of the uncertainty out of the markets, but you're still looking at things like the bond market and the US dollar and some different signals under the surface that make you concerned that we're not out of the woods yet and we still could have a contractive period. So I guess let's get your thoughts on the macroeconomic side first.
Yeah, well, as you pointed out, nothing has really been solved. We hear that Trump's going to just start assigning tariffs, not at random, but like what he thinks different countries deserve. That's no way to work out treaties with your friends and neighbors. And it's hard for any company to make investment plans and spending plans and all those other plans when they don't know what their input costs would be. And that's where the tariffs really come in, because those tariffs aren't paid by foreign countries. They are paid by the importers, and then they are or are not passed along to their customers. So there's still a lot of confusion and uncertainty. I know that Wall Street has gone whole hog into buying this relief rally. I am less than optimistic about that. I think we at least need a retest of the lows, and I would be surprised if we don't see one. And where you really see this is in the bond market, not the short end, but the long end. I mean, US 30-year treasuries, if you look at that, as you and I talked, the yield on that is now 4.967%. The last time it was like that was in 2023 when we had a small crisis, but the time before that, and the one which, if you look on a chart, is the next thing that comes up, is 2007, and when we had the great financial crisis. We are having stress in the long bonds when the crisis should be in the rearview mirror, or at least that's what the White House is telling us. But the long bond is saying, no, it is not. Because what the long bond is worried about is this budget bill that's likely to be passed by the Republicans in Congress. They don't need any Democratic votes to do it, apparently. And this is what the White House wants, and it's just a spendthrift city. It really is. I mean, when you look at this thing, how much they are going to increase the deficit and the debt, it's just extraordinary. They are going to increase the fiscal year 2027 deficit by nearly 600 billion. That means boosting the total deficit by about a third, from 1.7 trillion to 2.3 trillion. And then when you add into that the fact that they've cut a lot of funding for the IRS tax enforcers, and they were specifically focusing on the auditors for wealthy Americans, there's a big incentive for wealthy Americans not to pay their taxes, or at least not to pay all of them. And so that's going to decrease the amount of money coming in. So that's the stress we're seeing in the long bond right now, which is that the people in Washington, D.C. simply aren't serious about the deficit. And so now foreigners are kind of getting the feeling that we will probably end up printing money to actually pay for all this. And so, this is extraordinarily good for precious metals and stocks leveraged to precious metals. That's how we've been playing it. It's been working out quite well for us. But, longer term, it's not good for anyone. As long-term rates go up, the costs you pay on things like credit cards and home loans and all those things go higher. So it costs most Americans money. And I expect we're going to see home mortgages around 7% or so. Could go higher than that. I hope not. But, until they change things in Washington, D.C., this trend will continue. We're also going to see money rotate out of the U.S. markets. People seem to think that's all over with. No, it's not. We are seeing money rotate into Europe, into Japan, into Latin America. Now, this is helping my positions because I recommended European defense stocks to Wealth Megatrends. I recommended Latin American companies in the whole FinViz area for other publications. And I also recommended a big water company down in Brazil, as a matter of fact. Those are all doing well. Certain Canadian companies are doing well. And I haven't recommended Japanese companies yet, but I probably will. These markets are seeing a swell of money coming in. Now, they can't take too much too fast, which is the limiting factor on this. I mean, even if big investment firms and institutions and all that around the world wanted to take money out of the US and put it into other markets are so much smaller than us that they really can't do it fast. But it should be a steady drip, 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 which is going to support the positions I'm recommending, will support these markets overall. And it's just part of a big change we're seeing in the global markets, or at least that's how I see it. Now, other people can argue the other side of this, saying that the US has put its problems in the rearview mirror. But to come back to what you started this with, it was only a pause. And that isn't giving anyone any confidence, and it's just continuing the uncertainty that we've been living under for quite some time and probably going to have going forward.
No, Sean, I think that's the key aspect, right? Is that these markets have been driven by policy, whether it's been put in place or not, and that rhetoric around the policy. All we were hearing about was higher tariffs, more on the tariff front. Now we're hearing about deals getting signed, whether you like the deal or not. It does sound like the administration has changed their narrative to maybe less aggressive policy, but we do need to wait for the end of this pause. And then the administration looking at other things. We keep hearing, when are they going to deal with deregulation? When are they going to deal with taxes? Which now we're getting word that nothing is changing under this administration. We are just seeing higher and higher deficits. But that has also corresponded to a rebound in the markets, globally too. So how do you see investors' sentiment where a month and a half ago, everyone was defensive, everyone was fearful, every market dropped except for gold that benefited from that? Now it seems like investors are a little bit more bullish because all the markets have come back and gold has dropped. So where's the equilibrium on that debate between bullish, bearish outlook from investors?
Right. Well, I don't think everyone should be bearish. I mean, there are things I don't want to own, but there's plenty of things that I do want to own. As for the pullback in gold, I think that's ending sooner than later. I think this is a pullback, which is a normal and necessary thing in a bull market, which is what gold is in. Silver, too. I mean, when you're starting to look at some of these silver stocks, now we did have Mag Silver that got bought and stuff like that. But I'm speaking outside of the deals, of which there are more deals now. But outside of that, precious metal stocks look good, but it's not just precious metals. There is resilience in all sorts of things. And so I don't think anyone should be completely bearish. That said, I don't think they should be buying Wall Street's message on like the usual stuff like big tech. Some big tech will do well. Other big tech could have a real problem. Let's look at Google, for example. I mean, they have a big presentation, big celebration coming up, and like people are speaking about the new stuff they're going to roll out in that. Well, I mean, the way the stock is acting, it isn't going to be that exciting. I mean, because these things always get leaked, right? And we just aren't seeing a lot of traction in Google. And frankly, I think that's a company that's going to face extraordinary challenges going forward. I do a lot of my searches now through generative AI. Now, there is the problem that generative AI tends to imagine things. So you have to check whatever they come up with, but it saves me so much time just narrowing down my searches to what I really need to be looking at, that it's very helpful that way. So it certainly isn't anywhere where it needs to be, but it eventually is going to eat Google's lunch. So I think that's a problem people have to be aware of. So I think you should be more selective, and but I still think there are things that are worth buying. There are things not being bought yet that I think people will want to buy. We were all speaking before we actually got on the air on like all the bargains that are in the oil and gas space right now. There are stocks trading at or below their price to book value that are still expected to grow earnings, and they pay you a dividend to boot. I mean, the just value that I'm seeing in the oil and gas space right now really looks extraordinary. And in fact, one thing that I talked about at the Weiss Summit down in Boca Raton recently was the opportunity in the Canadian oil and gas space. There is just some bargains you can't ignore up there, especially since they're going to build that liquefied natural gas terminal and like stuff like that. So we'll probably see, movement of cash before that actually happens. So I'm seeing all sorts of opportunities across the space, but not in the stuff that I was looking at necessarily 2 years ago. I mean, not nearly as big tech heavy as it was, because some big tech stocks will do well, but others I think are really facing a threat to their business, whether it's from AI, whether it's from just this whole change in the global economic structure with like trade barriers and like stuff like that. There's a lot of stuff going on that is going to reshape the global trade landscape, and I think you have to take that into account too.
Yeah, Sean, it's really interesting because there's been some research done on European, particularly Scandinavian countries that were very heavily invested in the Mag 7, and some of them are pulling in their horns and moving it more domestically, like you say, in drips back into European stocks. So if some of those large sovereign wealth funds and pension funds start pulling out of the tech sector, it may cause some ripples. But to the point you just made about the oil sector, let's maybe dig in there. We have a lot of people that listen to the show that really focus on resources and resource investing. And with the oil stocks, whether they're US or Canadian, a lot of people are not really sure where things are going because oil prices have pulled back. Nat gas prices have corrected a little bit, but with all the incentives to get LNG exports in the US and Canada and start shipping it overseas, and with the idea that there's a lot of expansion and even M&A in the oil and gas space, what areas specifically of the Canadian or US energy space has your interest? Is it the bigger producers, the growth producers that are smaller? Do you like any of the oil services companies? Specifically, what areas of energy have your attention, Sean?
Okay, oil and gas. This is the segment of the program where we all blame Kazakhstan, because that's why OPEC raised its production limits, because Kazakhstan is cheating like mad on its production. So they're trying to teach them a lesson. So OPEC Plus is not mad at the U.S. producers, but U.S. producers are being hurt by the increased production limits that we've seen overseas. That said, I mean, a bunch of these stocks bottomed early, and they're looking beyond the current glut of oil that we have in the market, and they're looking at what will probably come next, which is that there's a bunch of U.S. producers, but also other producers around the world that are going to have to shut in some production, or at least not drill new wells when we have prices this low. So if you look around, you'll find some that are incredibly resilient. Those are the ones I would be looking at, because people know that those companies can actually make it through pretty much anything. I am not looking at the oil services stocks so much because the technology is changing so fast, and I'm not out there in the oil fields. I don't know who's going to be left behind. Somebody's going to win that game, but the tech is changing so fast. I'm not exactly who is actually going to be the big winner or winners. Probably the big companies there, because they're the ones that have the deep pockets to invest in the new tech. On the other hand, for the oil and gas producers themselves, I might be looking at medium, maybe even smaller, though I like medium-sized companies, because that's how the big oil companies add to their reserves now, is they buy other companies. And so one thing you might be looking for that I was actually looking for earlier today before we had our call is those medium-sized companies that they seem cheap considering the size of their assets. And so that's some number crunching people might want to do going forward, because while oil prices are down, you are going to see these larger companies that have more money than God, basically, trying to buy up things on what they consider on the cheap. And so you'll see a lot of deals being made, I think. And so I wouldn't be buying the larger oil stocks, because they're the ones who'll be doing the acquiring. Instead, I'll be looking at the medium-sized companies that are just going to be snapped up because their assets are underpriced. That's sweet spot that I'll definitely be looking at.
As of right now, the majors, the big caps have held up so much better through this
Yeah.
correction. So their share capital is also worth a lot more. Let's see some more M&A done. But Sean, what about the mix between oil and natural gas? Again, everyone keeps pointing to these LNG terminals to move price and to really help out the gassers, but that doesn't help out the oil companies. So are you leaning more towards the gassers then, or do you want to mix? What's your analysis leading you to?
Well, I am looking at natural gas, but on the electricity production side, because we're seeing such demand increase faster than anyone was actually expecting, like even 3 years ago. How much electricity they're going to need for all this stuff. It isn't just AI. We're seeing the electrification of everything. And so that means we need more power from power plants. You can talk about nuclear, but it's going to take you years to build new nuclear plants, much longer than it is to increase natural gas productivity. So that's the side I look at it. I mean, I have seen some research that the fall in oil prices is actually going to hurt natural gas production quite a bit, because a lot of it comes as as a side product to the oil. They're after the oil, but they build so much natural gas, they can't eject it off in the atmosphere anymore. So it just collects a lot. And I have seen some research saying we'll have a lot less natural gas production at these lower oil prices, which is quite interesting. I don't know if that's how you want to play it, but what I'm really looking at is utilities, which again, most people consider boring, but the way that electricity demand is going up, I think that's really interesting, especially because many of them pay nice dividends. Get paid a nice dividend to wait while these things are just building empires of energy. It's just really going to be fantastic. So that's how I'm playing that.
Sean, when you bring up the energy needs we're going to have, whether it's nuclear or nat gas or renewables, whatever it's going to be, we're still going to need a lot more copper wiring. And we still have people banging on the table about the copper narrative, which I know we've talked about till we're blue in the face here on the show. But I guess it's more of a when is it going to happen, Sean, story than it's. So how are you looking at something like copper where it's undeniable we're going to need more of it? There's supply demand issues, but it doesn't seem like the copper equities are responding that much, or the copper price for that matter, considering all these power demands that we supposedly hear are coming down the road.
I know. Isn't that one of the things that keeps me awake at night? When is the copper bull market coming? I don't know. I will say that Supercycle Investor just got a gold producer that's also a big copper producer. I mean, for its size, it is. And so I think there's some real potential there. I mean, I certainly am not turning away from copper companies. They haven't moved the way that we think they should. But, I mean, there's still plenty of time. They can still do okay. We're still early in the cycle on that. So maybe that's just a little bit, pushed further out on the cycle. That's all.
Well, the copper price is still historically pretty strong, right? And these
Yeah,
assets take a while to come on stream, and everything this electrification build out does take a while too. So would the play simply to be stick to what seem like the better assets here and now and have a longer term mentality on it?
maybe. But you know me, I'm always looking for something that's going to double. So I'm looking at those smaller things right now. And that's one reason that I recommended Gold Play that I gave Supercycle investor subscribers, because it does have that copper chaser, and so someone might pick them up for that. And really, I mean, I think copper is going to have a great decade. I don't think there's anything really bad about the companies in the space. The whole problem is, it is some kind of country going to shut down your copper project due to geopolitical reasons. That could happen to some certain players and like stuff like that. You have to be careful. But as long as your political risks are low enough, I definitely think you should really be in the space.
Well, I think we'll wrap it up there for today, Sean, but it's an interesting point that there are a lot of gold companies and even other base metals companies that give you copper exposure without having to be 100% in copper. So there's some hybrid plays out there that give you advantages of precious metals and the increase in gold, but still getting the copper kicker. It's helping with permitting in some cases, and it's considered a strategic metal in many countries. So if you're in a friendly environment, a friendly jurisdiction, as you point out, still some ways to play the copper space. But I appreciate you weighing in on gold, on the economy, on the oil stocks, utility stocks, and copper. And for those that want to follow along with more of Sean's output, he's got a lot of different services, and we'll put a couple links down below in the show notes over to Weiss Ratings, where you can check out Supercycle Investor, Wealth Megatrends, and also Resource Trader, where he focuses on some of the mining stocks. So, Sean, always great having you on the show, and as always, looking forward to our next conversation.
Thanks very much, guys.